Good morning, everyone. This is Maneet. I'm a real estate agent in Winnipeg. This is our very first podcast, and with me, I have Shiv. He's a very
First
good friend of mine,
podcast.
a real estate mortgage advisor from Inspiria. So, Shiv, welcome.
Thank you so much. I'm honored to be the first guest.
Thank you so much for inviting us in your new office. It's a beautiful place.
Pleasure's all ours.
Thank you, thank you. So today we'll be talking few things about real estate, mortgage, current market status, and of course, first-time home buyers as well. So Shiv, let's put some focus on market trend, what's happening right now. When we talk about rates are high, some people are scared. Should they make a move to buy the house or wait? What are your suggestions?
Again, this is the current thing that everyone is scared. Oh my God, rates are high. What am I supposed to do? I'm not getting qualified. This, that, and now. This whole right now, if someone can qualify for a mortgage right now, this is the best time to buy. Reason why? The thing is, you have more negotiation power.
Correct.
With the sellers. You have known this, right? And let's say if you go even put on an offer, you can make a better deal a little bit here and there. Let's say when the rates go down, there are multiple buyers.
Yeah.
Then you can't negotiate.
No.
Then it's on the seller's terms that, hey, I want this. If you don't give me this, bye bye.
So this is buyer's market.
Oh,
you're
of
trying to
course.
say.
Oh, of course. It is a buyer's market any day, because the thing is, when there are less people in the market and there's more inventory available to you, there's a supply demand chain, right? There's more supply, less demand. Now you can negotiate what you want.
So right now for the buyers, there are more options.
Of course,
and they can negotiate.
Again, exactly.
Yes.
You got the point.
Yes.
And what I'm also seeing the trend is like people are waiting for, oh, the rates are going to come down. Rates are going to come down. Bank of Canada is also saying that, hey, the rates will come down. But again, if you keep waiting for the rates to get cut down, then there will be more buyers in the market. There will be less chances for you to actually get the house for a lower price or even a better deal, right? Maybe they will include something in it, right? And when there are multiple buyers, multiple offers, then the seller's just like, oh, I don't want to give anything away. I just want to keep everything to myself, as I would too.
No, I remember a couple of years ago when rates were very low and it was known as seller's market. You go buy a brand new house, there's not a single penny negotiating.
No.
Nothing's happening.
I know the rates when they were 2%, 1.8, 1.9. Those rates, their clients used to just come to me, Shiv, clean offer. Just give me the pre-approval now and get it over with.
Yeah, right now it's more into buyer's hand. The game is in buyer's hand.
Of course.
Yes. So again, as a professional realtor and a mortgage specialist, we recommend to take an action today. The reason is, yes, rates are a little higher, but you're saving money when you're buying the house. Then maybe lock for 1 or 2 years. When the rates go low, you already bought the house on low price, refinance it.
Of course.
It's win-win situation.
Because the thing is, we are looking at a long-term thing than a short-term thing. Most of the people, what they see is like, I want the lowest rate, but if it increases my purchase price by 50,000, 40,000, I'm okay with it. That's a very wrong mentality, right? Because you're thinking about the long term. The loan's going to be for 25, 30 years, right? And the term for the interest, it'll just be for 1 or 2 or maybe 5 years, right?
Yeah.
That's very short-term thinking that, oh, I want a low rate. What if after 5 years, now the rates went back to 6 or 7%? What are you going to do then?
Then you're stuck.
Exactly. Then you have to figure out another way. That how am I going to afford my mortgage?
Yes.
That a lot of people are going to do right now, because back in the time they didn't care.
Now
50,000? Sure.
Yeah.
I'm qualified for that because the rate's 2%.
Yes, yes. Talking about rate, qualifying rate, how does that work?
Okay, so qualifying rates recently has changed. First, it used to be the prime rate, and you have to qualify on the prime rate. Now what they have done is, whatever your rate you're getting, let's say I'm giving you a 6% rate for 1 year fixed, banks want me to qualify you at 8%.
Oh, so whatever rate is plus 2%.
Plus 2.
Okay.
So that is what's killing a little bit of the buyer's share, is that whenever someone has that plus 2, the qualifying power goes down a lot.
So qualifying rate is when bank use to qualify you as a pre-approval.
It's like a stress test. Let's say if things don't go in your favor later on, then those guys have that little bit of a 2% leeway that okay, this guy can afford the house.
Yeah.
Let's say if the
So
interest
this
rate,
is in favor of the buyer.
it is a favor on the buyer, but again, some buyers who want to buy a bigger house, not in favor of them, right? Because they can't afford the
No,
house
when
at
I
the
say
moment.
in favor, meaning, say bank said, okay, go buy a house worth $600,000. Meaning bank has done their research on the buyer's buying capacity,
Of course.
and they have left some room that if they buy the house worth $600,000, they were actually okay to buy $800,000.
800,000,
Now they
exactly.
can easily make mortgage payments, property taxes,
Exactly.
insurances, and still live their life, right?
So it is a good thing, right? And especially in our market because it's unstable right now. Canada's whole market is unstable.
Correct.
Toronto, Vancouver, Calgary, Winnipeg, anywhere. So what the Bank of Canada has done is a good thing for the consumer, and but again, some people who don't want to have that little bit smaller house, they want a bigger
Something
house,
bigger, yeah.
they get frustrated. Talking to me, not to you.
Well, then look for a better job.
Exactly.
Find more means of income.
Of course.
Yes.
I'll come to you for that.
So next topic, Shiv, we can talk is buying versus renting. A lot of time I come across buyers who don't want to buy because they are so in use of renting or in habit of renting, they're enjoying it. Is it good thing to rent? What are your thoughts?
It's a 90-10 situation. I'll tell you why it's a 90-10 situation. 90% it's bad to rent. Why? Because all your money is going to a place and you're paying someone else's mortgage or you're paying for someone else. You're putting money in someone else's pocket, right?
Yeah.
10% might be good because what if you want to move? You're not certain about your life. You don't know what you're doing in the city. Maybe you want to go to a different city. You want a different job. That is completely
Or
fine.
you knew
Or you're new, right?
New
You
to
don't
Canada.
know, new to Canada again. As I say, like you don't know, you don't have anything certain, right? Because of course, home buying is a commitment.
commitment, long-term commitment.
It's a very long-term commitment, and again, the 90% I still put a lot of emphasis on that because the thing is, if you're giving away your rent right now, rents are around $1,200, $1,500 for two, three bedrooms, right?
Yeah.
And if right now, even if you go for a mortgage, it might be for $2,000, $2,500. But the new trend in the market is that people rent, they live on the top side, but they have a secondary suite. They're looking for houses.
That's getting very common now.
It is getting very
Yes.
common.
And very smart way.
It is a very smart way because they rent out the basement. It might be their friends. If not the friends, they rent out to a proper tenant. They have a proper contract, and then they're getting like $1,200 or $1,100 from that, and then that's it. And then they're paying almost half of their mortgage. So that is a very smart way of what people are doing at the moment. And even though if you don't have that extra secondary suite, it's still better than owning a house than renting a place, right? Because you can't call that place yours at the end of the day.
See, this is what I look at. In Canada, you have to pay to live.
Of course.
You pick. You want to pay your mortgage or your landlord's mortgage.
Of course.
Right?
Yeah.
Either or you have to pay.
I'm a landlord too, and I love my tenants. They pay for my mortgage, and after 25 years, I'll have that paid off fully.
Yeah.
I'll be very happy.
You're enjoying.
Yeah, and we'll go to Mexico together.
We can. On his expense.
Yes.
It's on the video.
No, not my expense.
You use
Tenant's
it, yes.
expense.
Okay, no. Financing options.
Okay.
When someone comes to you to do pre-approval or a final approval when they have found the house, how do you guys pick what financing options are good for the
It's
buyers?
a very wide spectrum about, some buyers are good with their employment, some are self-employed, some, have a lot of different things, right? So you can't just have everyone fit in one.
Correct.
Right? Previously, I worked in a bank and I used to have to sell the bank that, hey, this is good for you.
This is the product.
It is a product, right?
Yes.
But now, as a mortgage broker, what I pride in is I can explain to the client, hey, I know this bank will not be good for you, but I have another lender which will fit your criteria right away, right?
Yeah.
Let's say someone comes to me who's a self-employed person, right? They do not show taxes. We don't like to show taxes. Showing taxes meaning like they have a lot of expenses in the business, and with the taxes, it comes down to they make 200K in the actual business, but then it comes down with all the expenses, everything, to maybe 80K or 70K, right?
Okay.
On the documentation. Yeah. So what some lenders we have that they can use stated income program.
Okay.
Stated income is that I state that my income is 200K. We show them bank statements that there are deposits coming in.
Okay.
And then the bank sees, oh yeah, this guy has a lot of deposits coming in. I think we're good to go. And that's a stated income program that some lenders use.
So those are for business owners.
Business owners, right?
Yeah.
Because they don't have a set salary that, oh, this guy's gonna get 2,000 every bi-weekly or monthly, right?
Yeah.
So for those guys, because income is very uncertain, right? For self-employed people, because one month they'll make 50,000, another month they'll make 20, another month they'll make zero. So it's very uncertain. So that's why when banks have these kind of or lenders have these kind of programs, it's very good for all the consumers.
So if someone owns a business,
Mm-hmm.
for how long they have to own the business in order to qualify to buy the
It could be
house?
as low as a year.
Oh, okay.
Yeah, because they want to see 12 months of bank statements.
That's it.
That's it. And they want to see the corporation that it's under your name, under your, oh, and if it's split by someone else, then the income also gets split by other people.
Of course. So if someone owns a business for 1 year, they can buy the house with 5% down payment or?
No. So that program is only if you do 20 down,
Okay.
right? If you want to go into the CMHC program, some lenders are okay with doing the stuff, right?
Okay.
But the thing is, you also now, when you're putting less than 20 down, you have to come in the criteria of the insurer that is insuring the bank against you.
Against you.
Okay, that let's say if tomorrow you get defaulted, they can help the bank pay for you.
Okay.
So that's what the insurer's role is basically.
Okay.
And at the end of the day, you have to also come in the criteria of the insurer, and the insurer wants to make sure that your income is proper. There's proper 2 years. There's all on government documents that hey, this is the income that this guy is making. They don't want to go any bank statements or anything like that. So that is very clear with them.
Yeah.
But again, once you hit that 20%, then banks have a little bit of a leeway to make sure that your
They get
mortgage
more,
works.
more lenient.
Exactly.
Okay.
Exactly.
That's good to know. So, but as a buyer, first time home buyer, especially if they're not business owner, they're just normal people making salaries and stuff, they're okay with 5%.
Of course, yeah. If you qualify at 5%, you're more than welcome to go use that 5%. And I actually recommend my first time home buyers that either put 5 or 20. Right? If there's a leeway that
If they
you
have
can, yeah, of
access
course,
to the funds.
of course. And yeah, most of my clients I recommend to do a 5% just so because they're starting out, they don't have a lot of money, and then first start minimum down, then we'll work on it later on. And also you can pay off the loan while you're doing it too. So almost every bank, what they do is they give you a certain amount of fixture that you can pay off this much in this year
Okay.
without interest. So a principal
Without
amount.
penalty.
Yeah.
Without penalty. Okay.
Yeah.
That's good to
So
know.
there's a certain amount a year end. Okay, in this year you can pay this much. Let's say 5. I'm not exactly 5,000. Every lender
Example, yeah.
it's an example, but let's say if it's 5,000, you can pay 5,000 every year towards your principal loan.
Okay.
So a lot of people use that to pay off their mortgage faster.
That's good to know.
Yeah.
So, meaning if you have 25 years to pay, you can pay a little earlier.
Of course.
Save some money.
Of course, yes.
Or you can refinance and put down towards your next property or rental property.
Let's say if you have 5% down, right, and then let's say you bought a house for 350. Now the house is worth like 450.
Yeah.
It grew 100K.
Equity. Yeah.
Equity came in it. Now you can refinance, maybe use the 40,000 wherever you want, like in a second home. Banks don't have an issue with that. Put 20 down, buy a rental, make it your rental house.
One question for you, Shiv. Say a client got pre-approved to buy a house worth $500,000, but he decided to buy a condo. So his buying power for house or condo will be same?
No.
Because of condo fee?
There will be a condo fee.
Yeah.
Again, everything has different structures,
Yeah.
right? Let's say a house, what we calculate is like whatever the heating will be, whatever the taxes will be. Some lenders also calculate the insurance for the fire and all this stuff.
In the mortgage?
In the mortgage.
As a pre-approval?
They want to make sure that this person is fully equipped, that there's no surprises for them.
Correct.
Okay? And for a condo, let's say if the house is 500K and the condo is 500K, and let's say Jimmy is making 100K, He might be approved for the house, but might not be approved for the condo because there's a condo fee of almost $200-300
Yes.
that we don't know about. Some condos there isn't, but most of them,
Mostly they are.
99% there is, right? And condos also have a tax, property tax
Property
too.
tax, yeah.
So again, those things have to get into consideration.
So meaning the buying power might go down
It might.
if you're buying a condo.
Again, depends on the property, depends on what you're buying, what are you looking at.
How important is credit score when you're doing pre-approval?
Credit score is very important. Credit score is actually basically kind of like a credit report.
Okay.
It's like a report for yourself.
From school.
It's like a report card, right? Which we both didn't have very well.
You had better than me.
Let's see. After this, we will compare. But again, credit itself is very important because it shows that how well you are maintaining your money, right? How well you're taking loans, how well you're paying them back. Have you missed any payments? Are you utilizing yourself a lot, right? Okay. Let's say if all of the credit cards, all the banks gave you 60K, is Maneet just going out and spending 60K and paying minimum on it? Or Maneet's being very smart and just saying, okay, I want to make sure I don't use more than 30%. Yeah, more than 30. I would say don't use more than 30%.
So that's the best thing.
That's the very best thing, because what it does is that it doesn't make your banks look at three things, right? In the credit report, they look at first how much you're utilizing the credit. Second, how well you're paying them off.
Okay.
Right? And third, they're looking at is how many credit checks are happening.
Okay.
Right? Because the thing is, when there's multiple credit checks from multiple banks, for let's say a lot of I have seen in the young crowd is that they have multiple credit checks for auto loans.
Yes.
TD, CIBC, this, that, in a span of literally 1 month. And what this shows to the lender or the bank is that this person is desperate for money.
Okay.
Right? Of course, like as a lender, let's say you have the money and you're looking at someone's report and you're like, why is this guy going to so many places? Why didn't TD approve him at the first time?
Yeah.
Why are they going so many places? Right? It's a general question.
Yes.
They don't know that they went to a dealer. Dealer's like, I'll send it everywhere, wherever the approval comes from.
That's what they do.
Wherever the approval comes from, I'm going to take it.
Yeah.
But again, at the end of the day, some things are mitigatable, right? Some things we can explain to the lender, okay, this happened. There's some things like there's a ticketing or like a speeding ticket that they're fighting. It shows on the credit report. It shows on the consumer report. We're like, okay,
that can be...
It can be mitigatable, right? Some things are not mitigatable, right?
Yes.
And there is no explanation for me to tell why this guy has gone to 5 banks for a mortgage.
Yeah.
Right? The new lender will ask, why did this guy not get approved from these other 5?
Something's wrong.
Something is wrong. I want to find out now.
Yeah.
So now that what it makes is it makes my job a little bit difficult and also for the client as well, right?
So what's a good score to qualify to buy a house?
Usually, I tell the clients try to be above 650.
Okay.
Right? Some lenders just don't even want to look at it if it's under 680.
Oh.
Yeah.
So between 650 and 680 is
you should be
manageable.
Yeah, like if you go anything under 650, now that's the tough part. I'm not saying it's a completely shut off that no, you can't get it, but it's just that your options come a little bit lower than what you had before.
But if someone has lower score, it can be fixed.
Of course, yes.
Right?
Again, as I said, this is a report card, right?
Yeah.
When you go to a parent-teachers meeting and your teacher tells your parents, hey, he has to do this, and he can fix his grades. He can be number 1 in the class.
That's a very good idea.
Right?
Very good example.
Yeah.
Yeah.
So at the end of the day, it's just you have to sit down with a proper professional, right? And then sitting down with the professional will tell you that, okay, now you have to do this, pay this loan off, use this, use that. Sometimes people have so much equity in their house and they're paying off minimum payments on their credit card. And I tell them, I'm like, use that equity. Yeah, use that equity, pay off that.
It's lack of knowledge.
Lack of education.
Yes. In that particular field for funds, or you can say, what's the right word should be? Not coming in my mind.
People love to listen to their friends more than an advisor.
Yes.
That's what they do.
Co-workers.
Co-workers, friends, anyone.
Because they meet them every day, right?
Yeah.
They trust them.
Oh, you go to the bank? Why didn't you go to the broker? Another friend will come. why you went to the broker? Why didn't you go to the bank? Now the person is like, where am I supposed to go? Leave it. I'll just stay at home.
I heard something about federal government have some kind of program regarding down payment
Yeah.
assistance. What
So-
exactly is that?
So it's a basically what the government does is helps you have a little bit higher of a down payment, right?
Yeah.
So let's say if you had 5% available of your own funds, government what they can allow you is that they can allow you another 5% and make the down payment 10%.
Okay.
So if someone was not qualifying at 5% and if they qualify at 10, that's a good reason for them to buy, right?
Yes.
And again, it's a very good initiative by the bank, but it's only for first time home buyers.
And they have to qualify.
And they have to qualify.
It's not for everyone.
Not for everyone.
So I'm confused. I have a question for you. If I'm a buyer, first time buyer, and I do qualify for the assistance from the government,
Yeah.
I put 5% and they gave 5%. That
Yes.
became 10%.
Yes.
They'll help me to lower my monthly mortgage because the borrowing is now instead of 95%, I'm borrowing 90%.
90%.
Will that reduce my CMHC fee?
Yes. That will, because again, the CMHC fees is basically whatever the purchase price is.
Yes.
Minus the mortgage, and then again that will, of course, let's say if you put down 15%, that will also decrease your CMHC fees, not by a lot.
Yeah.
It'll be-
But the fact that this 10% is not entirely mine. 5 is mine. 5 was given from
Yeah,
the
but still
federal government.
CMHC will be decreased a little
That's
bit.
good to
Yeah.
know. Okay.
But again, that will.
It's minor, but
yeah,
still there is some.
there's some benefit to
Yes,
it.
yes. So now sometimes I get asked this question, even though I'm not the right person, I'm not a mortgage specialist, that do they have to give this money back?
Yes.
So can you explain when, how much, all those things?
The thing is that when they have to give this back is maybe when they're starting to sell the house.
Okay.
Okay, or maybe after 25 years when the mortgage is done.
Okay, so either they sell the house or 25 years.
Yeah, and
What if they refinance the house?
refinance the house is there are different rules with that.
Okay.
They'll have to double check on which one they qualify for.
Okay, so
Okay.
there are different criteria.
Again, there are very different criteria. There's
Okay.
also that if you sell the house, you have to only repay like 8% of the acquired equity in the house. So
as interest.
As interest, yeah.
Okay.
So again, there are different scenarios. I can't just give you information on a very general level.
Yeah.
But again, it is a good plan for people.
It's case by case.
It's case by case,
Yeah.
exactly. And but at the end at the end of the day,
Okay. Okay. At the end of the day, yes.
at the end of the day, it's a good thing. Right?
Okay. Now, say I own a house. I sold it 5 years ago. Am I a new home buyer now or no?
No.
Okay.
There's a very big misconception though that you cannot do again. You'll have to put down 20 down again.
Yes.
You don't have to put down 20.
Okay.
Right? Why you're not a new?
No, I'm not going there. My question was toward this.
No. Yeah, again,
program.
first time home buyers program is purely who are trying to buy a home first time.
Very first time.
Very first
Okay.
time.
Oh.
And
Now let's talk about 20% that you
Yeah.
were saying. Okay.
And also that 20%, there's a very big misconception that if you put down 5 or 10% in your first home,
Yeah.
and you're trying to now maybe upgrade a house or maybe go into a better house, that you cannot do that on the second house. You can. You can go into a 5 or 10%
Oh, you can.
down payment
Okay.
if you are renting your old house.
Oh, so if the first house becomes your investment property, and your second house has become your primary
residence, then you can use the 5 or 10% or 15% down payment. You can use CMHC insurance.
Okay.
Yeah, because what it is basically you're giving as an old house is your investment property, is your rental property, so it doesn't matter, right?
Correct.
Now the new property is the primary residence, so now you can use a CMHC as how it was. So that's why a lot of misconception is spread in our community that once you do 5%, you can't do that again.
So if you want to know more about CMHC, what exactly it is, I will be sharing his information.
Of course, yeah.
Call him, text him, email him.
Yeah.
And he's very friendly. Down payment, we already spoke. Buyers do ask what else funds they require when they're buying a house except down payment? Anything else needed?
Of course, down payment is one part of the engine. They also require closing costs. Closing costs, I usually recommend it's 2% of your purchase price. Let's say if
Okay.
it's 500,000, you should have 10,000 on a separate
Okay.
account. So not a separate, but like have it separate.
Keep it there.
Keep it there because again, it's a cushion that you might. I'm not saying it'll be charging you 2% for sure. It might be 1.5, 1.4, whatever the closing
So
cost
two
be.
is maximum.
Two is a recommended amount.
Okay.
Okay, and sometimes it's more than 2%, but 2% is the recommended
I
amount.
was told brand new houses can be a little bit higher.
Exactly.
Couple
So
$100, not a lot.
yeah. So again, I don't want to exactly put it's only going to be 2%, and people on the video like, no, I paid more. Again, you can pay more depending on again case by case, but 2% is kind of like a general rule of thumb that makes sure that the client has extra 2% available other than the down payment.
Okay.
And of course, have some money for the furniture as well because
Moving cost, cleaning.
of course, moving, cleaning,
I have
furniture.
seen some sellers sell the house and the house is upside down.
Yeah.
Not cleaned properly. So for those cases, keep some funds available.
Of course.
You never know, right?
Mm-hmm.
You might have to change the locks. Some buyers want to keep it safe,
Of course.
because you don't know who
has
owned
the
the
key.
house before, who have
Yeah.
the keys for that house. So
Mhm.
change the locks. So you need some funds for their cleaning, moving, all those
Yeah.
expenses that might occur.
Of course.
Okay.
And again, it's not just you give a down payment and now you're empty and now we'll work from it, right? I always recommend my clients to have at least 2 months of payments available at the account as well. Other than the closing cost and the down payment, make sure you at least have two minimum payments that you can pay for the mortgage available in your bank account.
That's a good idea.
Because I know in that moving, shifting, and all that stuff, you're not gonna be at work.
Oh yes, that's true.
Right?
Take holidays.
You take holidays, you'll be off work. Maybe there'll be less hours that you put in work. There'll be less pay.
Sometimes get your friends to help you move. You have to pay them, not pay them, but feed them.
Of course,
all those things.
of course. So again, at the end of the day, I tell this is good practices.
Yeah.
Again, I'm not saying you have to do it, but again, it's recommended.
Yes.
Right.
Have you heard about some scams going on? As scam in the sense of people calling, we want to get mortgage done, but they don't live in Winnipeg or even Canada sometimes.
Yes. I have actually got a call from someone in Toronto.
Okay.
They're saying we bought a house here all cash, and we want to refinance now.
Okay.
And after refinancing, we want to take the equity out. I'm like, okay, so tell me your address. He's like, I'm not sure what my address is right now, but I'll give you a call later on. I'm like, you bought a house all cash.
Yeah.
You don't know the address?
Did he call you back though?
No.
So what was his intention? What he wanted to do?
His what I think his intention was that he was trying to get something out of me that I don't need your thing. Just come to my office. We'll work something out. I'll get it done for you. Or even
And
maybe
he was here?
no, in Toronto.
In Toronto.
He called me on WhatsApp. So again, that's what I'm thinking. I'm not sure. Maybe he was trying to get something out of me or something like that. But it was a very weird request. You bought a whole house, 500K cash. You don't know the address.
Wow.
You must make a lot of money.
Maybe. There are some kids you don't know of. Same way.
Exactly.
Okay. So
But do you face any of these like
long
like
time ago,
scams or anything like
long
that?
time ago, I was marketing condos that they were getting built in south part of Winnipeg.
Mm-hmm.
So I was doing a lot of marketing online, social media and stuff. I got few calls. One was from, I think, Dubai or something, maybe Middle East. He wanted to buy 2 or 3 units cash. That was shady. Like they will ask questions and they will give you so much of hopes with money is not an issue. But when you ask them question, they have no answer. For example, when are you gonna come here? Oh, maybe my friend can meet you. Okay, your friend's here. What's his name and number? And now they have no answer.
Okay.
So with those, actually, that's a good thing too for our viewers. You get a call like this, ask them questions.
Exactly.
First 2-3 questions will tell you who they are.
Mm-hmm.
more example, we get calls from Telus or Rogers. They're from Toronto. Oh, we can give you this deal and all those things. All pranks, all fake.
Oh, of course.
So don't give any information.
At very last.
Yes, yes. Yeah, but try them first, right?
Try them. Of course, ask them questions. What are you calling? Where you got my number? I mean, our numbers are all over
All
the
over,
place.
yeah.
But let's say if you're just normal working with a salaried income, your number is not outside. I would recommend you to actually ask them where you got my number from.
That's good thing. Last question.
Yes.
A house or a real estate.
Mhm.
It can be a piece of land, it can be house, it can be condo, townhouse. What do you call it? Do you call it as a liability or an asset?
I would say it's an asset at the end of the day, right? Because at the end, if you look at it, uh, because I always like to think long term, right? Maybe some people are short term. Oh, right now I'm paying out of my pocket, but yes, after 25 years, look at how much equity will grow in it, how much equity, like, again, at the end of the day, what the end picture is, it's always a good picture if you buy into real estate, land, whatever you said, right? Because people are like, oh, yeah, but I have to pay so much right now, interest, this and that. I'm like, yes, but look at the bigger picture. What people are stuck in Canada, especially, are the smaller picture that right now I have to have this payment done. Such a big liability for me. And especially some online gurus, oh, never buy a house, rent.
They do?
They say that. They say that. They're like, oh, you should rent, don't buy a house.
Yeah.
It's
Well,
it's
that's
it's a
good. You have
liability.
rental property. Here we go.
Exactly. So he can live at my house.
Yeah, yeah.
But again, at the end of the day, what I would consider it an asset any day, because people sometimes they're like, oh, I have. In there's a in a if you look at a bank application, in the application it says assets, and under
Yes.
asset it says vehicle. What vehicle do you have?
So vehicle is an asset too?
I'm coming on it. And then you put down, okay, I have a 2015 Lexus, this,
Yeah.
and it's worth $50,000. Next year, if you go to the same application, you'll say I have 2015 Lexus, and now it's worth 40,000.
Okay.
It's a depreciating asset,
Yes,
right?
yes.
And most of the people in Canada have a payment on it,
Yes.
right? Everyone has, not everyone, but mostly everyone
Mostly people have that.
have a payment on it. So you have a payment on a depreciating asset. And people don't have any problem with it. No online guru is saying, oh, you should not buy cars. They're showing cars.
Yeah.
Buy a Lambo, buy a Rolls Royce, buy this, buy that. But no one tells you that you're putting your money in. Let's say even if your house is a liability, you're putting into a very good liability because it's appreciating
Yes.
instead of depreciating, right?
Correct.
So again,
That's a big difference.
it is a very big difference, right? And I want to encourage all the young crowd that stop putting big payments on the cars, but live below the means and make sure that you have some not depreciating, appreciating assets.
So that's your piece of advice.
Of course, any day. What is your advice? You're more senior.
Same. What is senior?
More senior in the market.
No, same.
He's only 2 years older.
So no, same thing. When we look at things, materialistic things, we
Of course.
get attracted towards that. Good brand clothing, cars, and all those things. Sure, buy them once you're there.
Of course.
Right? I don't know. I was watching one video of I forgot the name. He's very very good motivational speaker. He said, "Don't buy something until you have the amount that it costs to buy times 3 in your bank. For example, you buy a car which is worth $100,000, you have to have $300,000 in your account. Don't use the cash. Still finance it, but you have to have that much money.
Of course.
Then you're in the right track.
Of course.
If you have $2,000 in your bank and you're buying a car worth $100,000, you're doing no one a favor.
You're setting up yourself for your failure.
You are.
Right? Again, your whole life is you're setting yourself up, right? Either you can fail, either you can have a very good life. So if you're setting up yourself right now with failure in your early 20s or 30s, your 80s or 90s are not going to look very good. It'll be a very big nightmare.
Yes, yes. It was such a pleasure talking to you, and I hope our viewers have gained some knowledge.
Of course, yes.
We'll be sharing his name and number, and also any questions, please contact him. This was our very first podcast. We'll be coming up with more. Until then, take care and do something good.
Write in the comments, bring him again.
Yes, yes. Thank you so much.
All right. Thank you.